Welcome back once again. In the previous video, we have seen the syllabus, meaning and objectives of business finance. Today, we will see the scope and importance of business finance. So let us start with the scope of business finance. See, the scope of business finance is very wide and it is concerned with financial planning, policy formulation and control. The financial organization depends upon the nature and size of a business firm. It means that what type of business a particular organization is carrying out and what is the size of the firm is. If the firm is of smaller size, it will require lesser funds to carry out its operational activities. Whereas if it is a larger fund or if it is a firm of a large size, then it will require more amount of funds to carry out its operational activities. So the nature and the size of business firm plays an important role in the organization of finance. There are various fields covered by business finance and some of them are, first one is your financial planning and control. Your financial planning means deciding in advance how much fund is required and how much has to be spent and where to be spent. This is what your financial planning is. And to make these plannings and management, a financial manager must have the knowledge about the present financial situation of the firm. If he has a good knowledge of the present situation of the firm, he can make a proper planning of the finance considering the future outcomes of it. Financial budgets also play an important role in this as they provide a base to compare the plan with performance. If the performance is not going according to the plan, one can find out the deviations in it and can correct it. So your business finance consists of financial planning and control. Next comes deciding capital structure. Capital structure refers to the kind and proportion of different securities for raising funds. So what proportion you want debt and what proportion the company wants equity. So it is basically refers to the proportion of debt, preference capital and equity capital. There are various patterns or forms of capital structure like complete equity share or different proportions of equity and preference share capital, different proportions of equity and debenture capital, or company can opt for different proportions of equity, preference and debenture capitals. So these are the various forms and the patterns of capital structure that can be opted by a business. A decision about various sources for funds should be taken in respect of cost of raising funds. So your cost of raising fund is nothing but the cost of obtaining funds through debt or equity in order to finance an investment. If cost of raising fund is high, then such sources may not be useful for long. So a company have to see that where the cost of raising fund is less so that company can finance from those sources. So this is what your capital structure means. Now next comes selection of source of finance. After developing a capital structure, an appropriate source of finance is selected. So there are various sources from which finance may be raised. It includes share capital, debentures, commercial bank loans, financial institutions, public deposits, etc. So these are the various sources of finance available for a company. Next comes working capital management. The financial decision making that relates to current assets or short-term assets is known as working capital management. See, working capital is needed in order to carry out the day-to-day activities of the company. So it is a prerequisite to a long-term success and is an important factor in a business. And your working capital basically implies that current assets like cash, receivables and inventory should be managed efficiently and effectively in the business. So this is what your working capital management is. Next comes your capital budgeting. See, financial decision making related to long-term assets is known as capital budgeting. Or you can say capital budgeting means planning for capital assets. The capital budgeting decision means a decision as to whether or not money should be invested in long-term projects such as setting up of a factory or installing a machinery or creating additional capacity to manufacture, etc. It includes a financial analysis of the various proposals regarding capital expenditure to evaluate their impact on financial conditions of the company and to choose the best out of the various alternatives. So capital budgeting is basically a planning for capital assets, whether the company want to invest in particular asset for long-term investment or not. So this is what your capital budgeting is. Financial statement analysis. So another scope of business finance is to analyze financial statements. So this is one more scope of the business finance. Next comes dividend management. Business finance also analyzes the policies regarding dividend, depreciation and reserves. The firm should decide how much profit should be distributed as dividend and how much to retain as earnings for future use. And this decision should be taken very carefully by the financial manager to develop a sound dividend policy in the business. So this is what your dividend management is. So these were the scope of business finance. Let us move to the importance of business finance. Finance is one of the very subtle sectors of a business that can make or break a business entrepreneur. Every company needs finance for daily operations, and this is what makes finance very important area of concern. Below are some of the reasons why finance matters to a business organization. So let us see these points one by one. First is creation of profit. See, to create profit or to have profit, the first and the foremost necessary thing is that the business should keep running successfully. Then only a business firm can earn profit. So in this way, finance manager must go for the products and services which offers business profit while eliminating the ones causing losses. This means that the finance manager should invest the funds in those products and services which are gaining or which are offering profit to the business while eliminating the ones causing losses. In this way, it helps the business to keep running successfully, and ultimately the profit coming is also going to be increased. So in this way, finance helps in creating the profit for the organization. Okay. Next comes asset creation. Asset creation is nothing but the long-term investment. And the primary long-term objective for company owner is to scale up production by increasing the assets of the business. And investing in items like land, equipment and machinery will boost the production scale, but will only happen with intelligent financial management. So asset creation is done by investing the funds in the long-term assets. So in this way, a company creates its asset, and this asset is very necessary for the production purpose. And this production increases the assets of the business. And these asset creation are nothing but your land, equipment and machinery, which ultimately boost your production scale. And this happens only if the financial manager do the proper financial planning of its funds. So this is why your finance is very important in creating the assets in the business. Okay. Now next comes your operational expenses. Meeting the operational needs of an organization is what keeps a business going. Okay. If the business is running, it is common that there are some operational expenses which are to be met by the business. For example, cost of raw materials, inventory, remunerative payments to staff, interest payments, etc. So a proper financial plan must be made to stabilize profits in relation to operational expenses that are to be met by the business. So there must be a stabilization in the organization so that profit is also saved, and from those profit, the operational expenses of the business are also met. So finance is also needed for the paying of the business operational expenses by leaving aside the profit. So this is what your operational expenses here means. Next comes cash flow management. A business organization needs a strong financial team to handle cash flowing in and out of the company with all its records. So cash flow is basically concerned with how much cash is inflowing in the organization and how much is going out of the organization. And the whole point of cash flow management is to sustain enough liquidity to meet the operational expenses. Yes, cash is needed for meeting the operational expenses which occurs on daily basis. So this is why a proper management of cash flow should be done in the organization. Okay. Now next comes to manage unavoidable risk or uncertain risk. See, natural phenomena along with the human errors can be leading reasons for business to suffer loss. Okay, so before that time comes, a business should pull out a contingency plans that will prepare it to manage unavoidable risk. So there are various unavoidable risks which are faced by the company or the uncertain risk. It could be natural or it could be human made, like strikes, fire. So these are what human errors, while natural phenomena can be floods, earthquake, etc. So these are the unavoidable risks which cannot be avoided. So in order to tackle these risks, a company should or an organization should pull out a contingency plan so that these can be managed by the business. And to pull out this contingency plan, such type of contingency plans, an organization or a business needs a proper management of finance in the business. So this is what your to manage unavoidable risk here means. Next comes your growth. See, success can bring a business to a difficult situation. Why it can bring a business to a difficult situation? Because if business is growing, if business is successfully running for a longer period of time, an entrepreneur thinks of expanding and diversify its business. So in order to expand and diversify its business, one needs a good financial planning in organization in order to execute the plan of expansion of business. So when the company is growing and for its expansion and diversification, one needs a good amount of finance to further invest in the project of expansion and diversification. So for the growth of the organization also one needs finance into it. So these were the importance of business finance to a business. So today we have seen the scope and the importance of business finance. So our first part of the first chapter is completed. So if you have any doubts, you can just comment in the comment section. Okay. Till then, thank you.